slipped a little bit, so that was kind of an encouragement, maybe that the Fed is, getting close to being done with its Fed hikes. So just wanted to kind of give you a little bit of that information before we got started.
And when you say 5%, you mean the fiscal year?
Fiscal. As that, I'm going to hand it over to Mr. Jackson to let him go through update and performance review.
Thank you, Charles. Good morning, everyone. Hope all's well. I'm going to be going from the executive summary book to the green-bound book. And as you turn to page 3, this is the highlights page. This is the one-page summary, just wraps on some of the key, touches on key issues from a trustee or oversight perspective. As you can see, the first bullet displays the value at the end of June, which was 31.2. As Charles said, we saw some favorable market environments since quarter end, so the current value at 32.7. And this is relative to the first quarter. It's down about 3.7 billion, and of that, about 3.5 was due to investment performance, and that flows to approximately 207 million for the second quarter. Overall, asset allocation was aligned with the strategic targets. What I would say is that the private equity, due to very strong returns, this is our illiquid asset class. So our ability to pull money out and put money in is constrained. Therefore, it's enjoyed some very strong returns, while the other portions of the market have declined. So we have an overweight of about 4.9%. Real estate, again, one of those asset classes that's performed well in this environment, is near target at 2.2%. And then we look at our public equities, which have been hit the hardest, falling short of their strategic targets, but not outside the ranges, certainly. For the fiscal year ended 2022, the total fund return was negative 8.5%. And that's versus the benchmark return, which was negative 10.9%. So again, you can't eat relative performance, but certainly when we structure an allocation, our hope is that it can participate in all environments, even positive markets as well as negative, to protect. And certainly that's been the case. But this is coming on the back of a fiscal year end last year where the fund was up 32.7%. So again, certainly a tough market from an absolute return standpoint. From a relative perspective, it's a little more reasonable. Second quarter was really similar, where we saw that the fund was down 10% versus 11.5% for the total fund benchmark. So again, favorable by 1.5%, but again, we're in the midst of a underperforming negative market environment. We have the underlying asset classes here, and I'll just summarize. Global equities, public equities really trailed during this period, but the bright spots and the positive spots are private equity and real estate. So your private assets held up very strongly. In the year, real estate was up almost 23%, and private equity was up about 26%. And that's the offset of the public equities and even fixed income, which were down. Over the long term, the fund is outperforming its benchmark over the trailing 3, 5, 10, and 15-year periods. So again, long-term performance, and we continue to be vigilant. We're long-term investors. For the strategic orientation, the fund has performed well in the past. So let's turn to page 5. There is a lot of numbers on this table, but as you look down the one quarter column, you see negative returns for the most part. And we look at the 1 year number, you see that the S&P 500 not only was down 10.6% for the year, but down 16% for the second quarter. So again, difficult second quarter to be sure. The S&P 500 did bounce in July, it was up 9.2%. So again, what's the takeaway here? We're in a very volatile market. And while we talk about things being priced in, new information rolls out on a daily basis, whether it's job reports, whether it's Fed commentary. But again, the headwinds that exist in the market right now are really front and center is the inflation issue, how that's going to be managed, having a huge impact in terms of the returns of fixed income. So you have a high inflation number coming in the second quarter at 9.1%. You have a vigilant Fed that is determined to squash inflation, which means that they're going to be increasing rates. Through the July meeting, they've increased rates 2.25%. The last two meetings, 75 basis points each, or 0.75% in each of those meetings. It's a legacy issue. It's one that Chairman Powell, as the Fed has backed off the language in the last year from inflation being transient to being a persistent problem, and he's determined that is not going to have a runaway inflation issue on his watch. So, as the Fed is vigilant about increasing rates to squash inflation, the impact it has is puts the brakes on the economy, cost of borrowing increases, and the concern is engineering a soft landing or throwing the market into a recession. So, what constitutes a recession? We've had 2 consecutive quarters of negative GDP. A common definition is 2 quarters of negative GDP is a recession. The Bureau of Economics is the party responsible for saying what is a recession, and their definition is more broad. So, not to get caught up in the vernacular of it is, it isn't. Suffice to say that we're in an environment where you have high inflation and a slowing economy, and that's for certain. So whether it's labeled a recession or a mild recession, we know that it's ahead. And that's what the market expectation is. As the news comes out and rolls out, are investors thinking that a recession is going to occur and it's going to be a deep one, or is it going to be milder and it's just something we have to work through? And also taking into account the sell-offs in the markets, were they overblown? So again, that's why you see this vacillating in the markets where very poor equity returns for the second quarter, very strong for July, backing off again in August. So again, volatility is the catchword here. So, with respect to what worked well, if you look to real estate, so the NCREIF Property Index, this is an index of unlevered properties, was up 10.9% year to date, up almost 24% over the last year. When you scan down to the Cambridge Private Equity, you see that over the last year, it was up about 22%. So here's the caveat. Private equity, those valuations are lagged. They're based on appraisals that come out 3 to 6 months afterwards. So this is a lagged number. That said, so we see when we're going to look at our private equity experience, certainly a strong number. But as we saw last year and the year before, the timing is not necessarily synchronized with what you think about public markets. So that said, good news overall for the portfolio, having the private equity and the real estate exposure both performing really well in this environment. Within the equity markets, what's worked and what hasn't? Through the second quarter, energy was the only positive performing sector. And we saw oil prices and energy was up 40% year to date through June 30th. Now that's come off since that point in time. We're now oil's under $100 a barrel, but again, when we look at these numbers, then we have to put this in context. We also, as we're going to see in a moment, have a style leadership change that has pretty significant implications for judging how your managers perform. Suffice to say, I'll summarize and say growth has been punished year to date. Value has reverted, taken a leadership position. Alex touched on that. We're going to spend a few moments just talking about the differences between the two styles. Well, we certainly see some of your growth managers being particularly hard hit in this particular 6-month period, whereas if we were to look back a year ago, they were the darlings of the portfolio. So again, the concentration, particularly in consumer discretionary and information technology stocks that did so well in the last 8-9 years were those that were particularly hard hit in this last year. So I'll take a pause there and answer any questions that you might have. Okay, let's turn to page 6. You know, let's turn to page 7. I think this captures the idea. What's contributing to inflation? So this is a kind of a busy chart, but I'm going to just focus in on 2 numbers here. You see the contribution to inflation, that transportation number at 3.3%, housing contributing about 3.2%, and then food and beverage 1.5%. These are the 3 areas of the economy that have contributed to this 9% CPI number. And we see that transportation category weight is about 18.2% of the index. Why is transportation such a big contributor? Energy, oil, all falls in that transportation category. So no surprises there. Let's turn to page 9. This is just more for your own consumption, but to say, you know, when we talked about this, the common definition versus the detailed definition is listed here. And again, when we talk about the Fed stepping in and increasing rates, how does this impact or slow the economy? Well, one of it is the borrowing cost, right? As we see the mortgage rates spike in an environment like that, making more expensive for buyers to secure loans, et cetera, a bigger portion of their budget, so there's less spending going on. And as the consumers, which accounts for 2/3 of the economy, spend less, we see the economy overall contracting. Okay. So let's, with that, turn to page 10. So Alex talked about, you know, how often do we see both fixed income and equities decline at the same time? Aren't they supposed to be diversified? Isn't that the point behind that strategic allocation? So this chart on page 10 is illustrating the correlation between the S&P 500 to the Bloomberg Aggregate Index, which is a fixed income proxy. Okay, this is an investment grade bond index compared to a large cap U.S. equity index. If things are moving in perfect step, it has a correlation of 1, which means no diversification. If you are not having the benefit of one going up while the other one's going down, then the diversification benefit is not there. Well, anything less than 1 has a diversification benefit. And here we see that there are periods where this number is in the left axis we see at 0.75. There certainly in the 90s were a lot of periods where correlations went up to 75, 80, and that's basically saying fixed income was up, equities were up, they were going up pretty much in tandem. Well, now we see the diversification benefit in the tech bubble bursting post-2000, as you see this diversification being, this correlation being negative, which is good news. That's the diversification benefit. That's telling you that when one's up, the other one's down, and baffling volatility. The takeaway is volatility is a drag on performance overall on the portfolio. And what we try to do is put together, think of an omelet. You might not like green peppers, but when you put it in with eggs and cheese, and suddenly it's very good. So, or maybe. So what that introduces is that things working together to baffle the volatility overall. So we see that there are periods where it's gone up, and certainly we see that on the far right column, then we see the spiking inflation, but again, overall, we see that the correlation between the two is negative, which is what we're looking for. So how often do fixed income and equities, are they negative together? About 10%. So as Alex said, looking back 100 years, if you look at the quarterly performance, you would say 10% of the quarters, both for fixed income and equities, are negative. So it's not unprecedented. It's not something that never happens. What we have is the risk investors that would deploy their assets in equity are skittish because they're concerned about a recession, which means they invest in equities, the economy slows down, the earnings of these companies get reduced, what they paid for suddenly looks more expensive than it's worth. On the fixed income side of the ledger, you have the concern about what I'm getting today in a coupon. If rates continue to increase, it is no longer worth as much as it was in the past. So I may be concerned about the vigilant Fed, how it's going to impact my fixed income portfolio. So you have both of those things that are taking place at the same time, thus you have both markets declining. So, any questions on that? I know that's a mouthful, but it's in the press all the time, so I'm sure you've heard word of it. On page 11, this is just the roster of indexes representing the different asset classes, and you can see the fiscal year to date, which is the 1-year number. There really was no place to hide in terms of not generating negative return. The little box to the left, we say that to kind of just plug in the most recent number. So July, for instance, the Russell 3000, the Russell 3000 is the 3,000 largest stocks traded in the U.S. market, was up 9.4%. Quarter to date, it's up 12.3%. EFA, which is the developed markets non-U.S. equities, up 6.73 in July. Emerging markets were actually negative, and the Bloomberg aggregate was up 2.44%. So again, what we saw in July was both equity markets and fixed markets generating positive returns. Let's turn to page 13. This is Trustee O'Bralen's chart. So we will look here and see that there's a lot of numbers here, but what this is trying to measure is, on a go-forward basis, price to equity is a metric to determine are securities overpriced, underpriced relative to historic standards, and you see the dotted lines are the standard deviation. So we can see in 2020 where the price exceeded the one standard deviation level, saying that equities were pricey at that point in time. Well, given that with the declines in markets, you can see that now they are more towards the historic levels at 15.9%, and even slightly below the historic average of 16.85 times. So, on page 14, this is, there are 3 takeaways here. One is that large cap stocks are outperforming small cap stocks. And why is that? In periods of uncertainty, larger cap securities have, these larger companies have greater access to capital, they have more diversified product lines, therefore they're not as subject to the whims of the market. So in times like this, we would tend to see, in times of uncertainty or concern, large cap stocks tend to perform better than small cap stocks. And that's certainly the case as we look at the Russell 1000, which is, let's use the S&P 500 because it's a common large cap index. We see that it was down 16% for the quarter. The Russell 2000 was down 17%. Over the last year, the S&P 500 was down 10.6%. Russell 2000 was down 25%. So again, the message there is large caps outperforming small caps. Now let's talk about value versus growth. We see that you look at the Russell 1000 growth and value. The Russell 1000 is 1,000. The Russell Index takes 3,000 stocks, the largest in the market, and they capture the largest 1,000 That's the large cap index, and then the next 2,000 is the small cap index. And then they divvy it up between growth and value. A shorthand term for value is stocks that are cheap. Growth stocks, shorthand definition is that they're stocks that may be more expensive because they've outperformed the markets and they've been bid on. So the two styles of investing, some investors are saying, I'm going to buy stocks that are on sale. I'm going to be a value investor. I'm going to hold them longer. The market isn't appreciating their true value. I'm going to hold onto those securities until they're once again valued by the market. Growth stocks, on the other hand, they're lighting it out. They've been outperforming, and they're wagering with their capital that it's going to continue to outperform. So the Russell 1000 growth was down 21% for the quarter. The Russell 1000 value was down 12.2. So that's an 8% differential. And we see over the 1 year period, Russell 1000 growth was down 19% versus the Russell 1000 value, which was down 7%. So that's a 12% differential due to style. Why would that be? It all goes back to the construction of the indexes. And the Russell 1000 growth is 43% information technology versus Russell 1000 value at 9%. So as information technology goes, so goes the index. And in the last quarter, the second quarter, Microsoft, which represents 6% of that index, was down 16.5%. Amazon down 35%. We have also Netflix was down. So again, what we call the FANG stocks, the big, large cap information technology stocks, were particularly hard hit in the second quarter, and so therefore the index underperforms. The value index, in contrast, has about 20% financials and about 17% in healthcare stocks. Russell 1000 growth has 3% financials. So again, so goes financials, so goes value indices. And they held their value to a greater extent during this period. So that kind of tells the story. Within consumer discretionary, which also, as you look at the bars on the bottom, was down 26%. Tesla represents about 1.8% of that index and was down 37%. So again, underlying securities make a difference. Weightings to particular names has an impact. So again, the takeaway is large outperforms small, value outperforms growth. That's in growth stocks that had quite a long run and did much better. So our growth managers that suffered in the second quarter, we saw a pretty good rebound in the month of July in terms of their relative performance. The same themes took place within the non-U.S. markets, and suffice to say the EFA, that's the developed market index, was down 14.5, down almost 18% for the year. What's kind of interesting is emerging markets. We saw that they have experienced some poor performance. For the quarter, they're down 11.4%, and that's with China, which is the only emerging market to be up, was up 3.4%. China represents north of 30% of the emerging market index. So when you see the bottom chart where the emerging market index was down 25%, China was down 32%. So again, it has a outsized impact. And what was taking place in China over the last year, their zero COVID policy led them to shut down Shanghai, contributing to the supply chain disruptions, so it had a big impact. And the perception now is that the worst is behind them and it's a return to normalcy. That said, we continue to see issues on the Chinese front. So, fixed income, I feel like I touched on that. We talked about the March, July, June, May meetings where they increased. The outlook is, at the last Fed meeting, is they may be increasing rates till they get to 3.4%. So again, we've got a few meetings left, and the perception is if they continue to see inflation numbers, they do have a 2% target. That's based on a different index than the CPI, but let's just say that if they continue to see the specter of inflation, they're going to continue to raise rates, and that's contributing to the sell-off that we've seen in the last week. Okay. Real estate, bright spot on page 19. The Odyssey is a levered collection of real estate core managers, so that's kind of a representative benchmark. And then we see the End Creek Property Index, that is unlevered real estate. So we see that the levered was up about 28.3% versus 21 for the unlevered real estate index. Suffice to say, strong returns for the quarter. Again, there's a case where you see the diversification benefit as public equities and fixed income markets are declining. They actually appreciate it, but again, they will be experiencing a slowdown as well with an increase in rates. Any questions on the markets as they turn? I know I've said quite a bit, but it's been quite an interesting, volatile market, a lot of things going on. Page 21, this just shows the diversification among your asset classes. So you see the asset classes and the dollar amounts, how they're distributed. The bottom line is 31.2 billion. And below you have the actual weights versus their target weights. So we see here the individual components. We have the percent difference and the dollar difference as well. When we are distributing funds for benefit payments, typically what we do is we take from the asset class. So this is a very efficient way of rebalancing and getting closer to our target. Issue is with private equity. We take the cash that's being thrown off and it contributes, but the bottom line is you can't go in and redeem like you might with public securities, so it's less liquid. So that said, you see that the run up in private equity versus the comparison to public securities. We will be modifying these targets based on the changes of the asset and liability study. We revisited that, we modified that. We're going to be taking down, so right now the actual weight for equity is about 53.9. With the change in the policy, we're going from 61 to 57. So again, that public equity underweight is going to be mitigated. All right, any questions there? Page 22, this is the cash flow summary, if you will. The values on the far right are the March balances, and it has the dollar value and then the percent of the total. Then we have the investment returns, and we see that the investment returns for the quarter were negative 3.5 billion. And then we see the net new investments. So that's the cash flow coming in, going out, a net of negative $207 million. So that's to pay for distributions, et cetera. And the ending value at 31.2. You can see when we look at the money that has come out in that column with a lot of red in there, you see that, again, that 58.6 million coming out of private equity. That's, again, as distributions are being kicked off by private equity, we're distributing that, and as well for real estate. And then you have your cash at 70.6 million. So again, lesser amounts coming from the equity side, greater amounts coming from the overweight asset classes where the cash is available. All right, let's turn to page 23. This is a chart that's got a lot going on, but it's going to be one of the summary charts here. As we look at the total fund, the way to read this chart is that we have the total fund is signified by the blue circle, giving its return. The benchmark is signified by the green triangle. And the peer universe here is the Callan Public Fund Sponsored Universe of very large plans with assets over 10 billion. So you have comparably sized assets. And here we see that the return for the total fund was down negative 10%. The policy benchmark was negative 11.5. The median was down 8.1%. So again, trailing the median, outperforming the benchmark, as was the case for the 1 year period. What is it about PERS allocation that contributes to that? Is that relative to the peers in the universe, have a greater level of public equity. That was one part of the rationale for introducing new strategies and getting legislative relief from that standpoint. Because right now, relative to peers, greater than average exposure to public equities, which has served the fund really well over time. But most recently, it appeared like what we're seeing now. Relative to peers, you're going to see some underperformance relative to the allocation index, if you will. The active management has performed well enough to support the shift. So over the last 3 years, the fund has returned 7.85% versus 5.98 for the benchmark. So outperforming the benchmark, and if you scan it straight up, you see that blue dot that's got a 40 next to it versus the benchmark of 84. So 40 meaning that it's in the 40th percentile, outperforming 60% of its peers. And if you scan across the blue numbers, you see over the last 15 years, the fund has outperformed 31, ranked 31, which means it outperforms 69% of its peers. Over the last decade, it's outperformed 84% of its peers. The last 7 years, 76% of its peers. So long-term performance, certainly strong versus benchmark and peer. So page 24, this is going to show the performance over the last quarter, fiscal year, the last 3 years, and then the subsequent pages, 5, 10, and 15 years. This shows the dollar amount, the weight, and the performance last quarter. So we see that the performance from domestic equity was negative 16.7% versus the benchmark, which was 16.7. So again, right in line with the benchmark. Over the last year, it's trailed, and our large cap exposure is really a combination of largely index plus one active manager that has underperformed in recent periods. Over the last 3 years, 9.57 versus 9.77. And what I would say is there, you're looking at that performance, albeit 20 basis points behind the index. It's in the 35th percentile of peers. In other words, outperforming 65% of the domestic equity peers. Fixed income, we see that in the last quarter, negative 5.8% versus the comprehensive benchmark at negative 4.7. So again, we see over the last year we have underperformance in the fixed income, and due largely to the fact that we have diversifying strategies within fixed income. One is emerging market debt, which has had a drag on performance overall for the fixed income. So fixed income, real estate, again, we see that if we look at real estate over the last fiscal year, up 22.8% versus 21.5 for the benchmark. And then over the last 3 years, up a little over 12 versus 10% for the benchmark. So again, we see that this real estate performance, and again, this is a combination of both core plus, and non-core managers have contributed value. Private equity, as we said, private equity benchmark, again, this is a public markets benchmark, so the disparity between what happens in the public markets and a private equity benchmark can be pretty drastic or extreme, and certainly that's the case. We see the private equity was up 26%, and the private equity benchmark, which is the S&P 500 plus a 3% premium, was down 7%. So again, what we see is, again, strong performance over the 1 year period from private equity. And cash is what it is, it's 30 basis points. So again, over the 1 year period, we see that we're on a relative basis versus its benchmark, up 1.5%, and versus its peers, it's trailing. So that is the story, and happy to take any questions that you might have.
Questions from the committee?
Thank you all.
We'll move on to the
wouldn't say it's difficult, it
It's
was,
not as easy, policy.
More changes.
yes. So, Mr. Chairman, if you'll indulge me, you'll open up your packet to the investment policy statement, red line version for the content plan. Again, just to kind of echo what Mr. Higgins said, a lot of this, a lot of the changes here, even though it looks like a lot, most of it is adding 2 new asset classes and adjusting the asset classes where the funds for those asset classes are eventually going to come from. There's a little bit of, you know, just some additions that Mr. Higgins, you know, requested to be added, just some housekeeping materials on pages 3 and 4. Moving on to the actual strategic asset allocation policy on page 11. Here is just, again, going through, showing the changes in total strategic asset allocation, what the policy targets will be after the change, discussing, you know, where the assets will be coming from, and then adding both private credit and private infrastructure, and, you know, their benchmarks. On page 14, just going through discussing, showing the changes in what will happen to public equities with the changes to total portfolio allocation there.
And changes based on something the board has already approved.
Correct. Page 16, moving on to private equity, just kind of cleaning up this with, you know, the addition of the 2% and kind of just going through and, you know, clarifying what investments that the asset class, the portfolio can invest in. Page 18, just going over fixed income, again, just, you know, showing the changes to this part of the portfolio when we fund, you know, the new asset class for private credit. And then starting on page 19 and 20, this is a completely new asset class. This is private credit. This is just going through outlining the objective of why we're adding private credit, talking about the implementation and what type of investments under this asset class the portfolio can use. Moving on to real estate. Now, real estate, a lot of these changes came because this section of the IPS read more as a operational manual instead of a policy statement. So we went through here, not changing anything that's, you know, of substance, just making it more of a policy statement instead of a, you know, how to manage real estate, which should belong in our operating procedure manual where most of this already resides. So basically, this is just going through and cleaning this up and making it more of an efficient policy. On page 31, 32, this is another new asset class for private infrastructure. Basically, again, going through the objectives of why we're adding infrastructure, and then going over the implementation for the asset class. And then the remainder is basically unchanged. Right? If there's any questions, I'd be happy to entertain that.
portfolio where it's gonna put strikeouts. Global has that 12%, and kind of carries across, and there's a 57% where there was 61. Is that just not looking correct on my screen, or is that? What's that 57%?
That's, the 57% is the percent of what total equities would be for the entire portfolio.
Which it should be the new amount, down to 61.
Yeah, and the one on the right is, it's 100% of the asset class itself. So it's broken down into 44% US, 36% non-US, and 20% global within just equities.
Okay.
Basically 100%, 57%, or how 57%.
Yes.
Other comments or questions?
So on page 20, it talks about private credit. It said it will consist of non-bank issued credit. What would we be looking at there?
Non-bank issue credit, these will be, these will be pieces of paper that will be issued directly by corporations, not traditional lending institutions.
So a bank has its own rules, is subject to, and these would not be, maybe subject to those outside of banking rules that may apply.
Yes, and also, I mean, some of the lenders may have, they may have good credit, and they can get better terms outside of the bank. So, I mean, there's lots of different reasons why it's going like that.
Any other questions, suggestions? If not, this is,
Yes, I'm asking for you to accept the changes to the IPS as presented to you.
is this one that would take initial adoption? Would this be that initial adoption?
No, sir, I don't think we've done that historically for the investment policy.
Okay.
That is accurate.
That's correct, sir.
Okay, so this will be final adoption for internal type.
Yes, sir.
All right, we have a motion for adoption or approval of the annual investment policy review, or the policy itself. We have a second.
Second.
Any further discussion? If not, then all those in favor say aye. Aye. Any opposed? All right. Motion passes.
And then next on the agenda is the manager watch list review. On this, there's two changes being requested. The one I'd like to talk about first is dimensional fund, which they are coming in to speak with us today. We are asking for them to be removed from the watch list. As you know, dimensional employs a very deep value strategy, and over the last almost decade now, value has underperformed and deep value has severely underperformed. But over the recent time periods, that has turned around, and their process has become more in favor, actually a very good favor. So we are asking for dimensional to be removed from the watch list. And then the next one I want to talk about is Epic. We are asking for them to be added to the watch list. At this point, we don't have major concerns, but procedurally, they have triggered the rolling 3-year performance, and we are asking for them to be added for extra scrutiny.
this addition of Epic based on lower 3-year returns and the removal of conventional plan advisory. Hearing a staff recommendation, do we have a motion? to approve? We have a motion, is there a second? Second. Motion and second. Any other discussion or questions? If not, those in favor say aye. Any opposed?
Well, few missteps on, most of it came in September of 21, and they've been working towards, recovering those losses, from that period, but, I have great confidence in the team, so we'll continue to monitor the progress. And at this point, we have a small cap manager presentation. I don't know if we want to bring it here for lunch and have manager presentations after lunch.
Message Wayne.
Okay with the committee? All right. Then we will break for lunch and come back 12:45.
At your place.
That work okay? Approve? All right.
Thank you.
You might decide not to come.
No, I'm not. I'm not sure why. He emailed me this morning and said he wouldn't be able to make it.
That is what I would say. I agree that, turn that off. But that's the,
Where's your lessons, you wanna do like dot, hold down period?
yeah, the skips or something. You can change those functionalities.
Now you tell me.
Are you sure about that?